Yeah.
Okay, hello, good evening, everybody. Welcome to today's webinar, which is about understanding the basics of investment in mutual fund. It is my pleasure to have here with us Mr. Bhavesh Sharma, who is the Senior Product Specialist at ICICI Prudential Asset Management Company. Mr. Bhavesh brings a wealth of experience in product development, strategy, and investor education. With over 42,000 investors and distributors educated across India, he is a well known figure in the financial industry. Please join me in welcoming Mr. Bhavesh to the webinar. Sir, the stage is all yours. Before you begin, just a quick note. Anybody who has questions, we would take the questions toward the end of the session in a question answer round. So please drop in your questions in the comment box below. Sir, over to you.
Thank you so much for that introduction. And I'll share the presentation and we can start. Okay, so I hope the presentation is visible. And as you can see, the topic that I have selected for today is the art of navigating volatile markets. Because I believe in the last few weeks, with all the things that has been happening around, many investors are worried whether the decision to invest in the market is correct or not. There are investors who always fall short of some guide, and that is why I thought that it is a very, very relevant time to host this kind of a webinar. And I will take you through the basics so that most of the investors who are confused about certain things that are happening start looking from a macro view. Most of the times we just focus on what's happening today or tomorrow or in a week, but what about the entire year, 5 year, 10 year, 20 year down the line? What is happening in that entire period? I believe that we should start looking things from the macro vision, and that is where the data also that we'll be showing you today is prepared from the perspective of a macro area. So over here you can see the slide where there is data for Indian equity in the last 20 years. And if you see, it has compounded by 16.1% in the last 20 years, which is a superb compounding. If you look at other asset classes in the same period, that is US equity, it has compounded by close to 14%. Gold has compounded by close to 12% in the last 20 years. Real estate at 8.5%. And your debt, for that, we will take a low duration debt fund. And over there, you can see returns are close to 7%. If someone has difficulty in understanding what do you mean by 16% compounded returns for 20-year period, there is an easier way also. You can see how much your wealth has multiplied in that entire period. For example, in case of Indian equity, the wealth has multiplied by almost 20 times in 20 years. Whereas in case of US equity, it is close to 14 times. In case of gold, it is close to 11 times. Real estate is 5 times, and debt is close to 4 times. So usually we look at absolute kind of a return. We say that my 20 lakhs invested, today's value is around 1 crore over a period of 20 years, and we are happy that it has grown by 5 times. However, what is the rate of growth on an annual basis? This is what gives us the proper idea. This is how we will be able to compare it with other asset class. When you do that, you will see clearly Indian equities are the winner with almost 16% compounding, and 20 times your money has grown in the last 20 years. And we are just talking about the broader index of Nifty 50 year. We are not even going into small cap, mid cap, or any other actively managed fund which might have done even better than this. So if suppose looking at this data, most of you must be thinking that Indian equities have done great. So when I will ask you, where has Indian investor invested the most in the last 20 years? What do you think the answer will be? Looking at this data, going by this data, ideally Indian equity should have been at the top followed by probably gold, then real estate, and then debt. But you'll be surprised to see the result. If you see, as out of the annual household savings, almost 50% is invested into real estate, 15% is in bank FDs, 15% is in gold, around 6% is in insurance, then comes your provident fund and pension funds. And is there anything left for equity? Close to 4.8% is there in equity. Even when your equities has generated highest returns, still the total percentage of an average person in equity is hardly 5%. Majority of the money is locked in real estate. Now, if you are doing real estate for your own self accommodation, then that's a different thing. We will not consider that as a part of investment. But if you have your own house and then still you are buying another real estate just for your investments, then probably you will have to look at these figures again, because clearly it is not the most rewarding asset class. Let's move ahead. If equity is generating close to 16%, real estate is generating close to 8.5%. Why do we need these kind of returns? Because many investors will associate these asset classes with a lot of risk. So why do you need these kind of returns? Why can't I be just happy with a 7% kind of a debt return? At least the risk is very less over there. Volatility is very less. Why should, and I can get my money anytime. There is good enough liquidity. Paperwork is easy. It is easy to understand that instrument. So why do I even need to do an equity or a real estate or a gold or any other asset class? Anything other than your fixed income instruments. So the biggest reason is inflation. Inflation is something which we all are aware of, but we don't take it very seriously because it is invisible. Inflation eats up your savings, it eats up your investments slowly and steadily over a long period of time. Now, the inflation rate in India, if you look at the average rates, it is close to six, it is between 6 to 7%. So, between 6 to 7% is where your average inflation lies over the last 40 years. Now, if suppose I have to beat the inflation, which is completely necessary, if I am unable to beat the inflation, then probably I am not generating wealth, I am destroying my wealth. So, I need to beat the inflation and that too on a post tax basis. So, all the investments that we saw here, whenever we redeem these investments, there will also be a tax applicability, be it your real estate, be it your fixed income instruments, be it gold, insurance, be it your equities. So, all these areas you also have some tax applicability. Post tax basis, am I able to beat the inflation, which is close to 6 or 7%? Sometimes it has gone to as high as 13%, other times it has been as low as 3 to 4%. But to beat an average inflation of 6 to 7% post tax basis, my returns should be at least 9 to 10%. And to generate 9 to 10%, we already saw in debt, it is very, very difficult. Hardly there has been a returns as high as 9 to 10%. In case of real estate, 8.5% again, not enough. In certain cases, in certain areas, maybe, probably, but most of the times it is not enough. In gold, gold has an inherent property to beat inflation. So, yes, you can make it work. But look at equities. Equities are one of the asset classes which can comfortably beat the inflation and on a post tax basis. That is another very, very important reason why we cannot just rely on traditional investment options. We have to look for the latest investment options also. So, an investor like you goes through a lot of dilemma, that which asset class is the best. Should I invest in equity, real estate? Should I do a simple fixed income instrument? Should I invest in gold, silver, something like that? If yes, then when should I enter? When should I exit that investment? What will be the taxation impact on each investments? What will be the expenses charged on each investments? There is also a question that if I'm investing into equity, should I invest into the biggest companies known as large cap? Should I invest into mid-sized companies known as mid cap, or should I be investing into small caps? So overall, there is a lot of dilemma, but one thing remains constant, that if you avoid all these things and if you just stay invested for a long period of time, then you won't have to suffer through this. So a very easily said but very difficult to follow. There are two very important things to create wealth in equity. One is patience, and the other one is discipline. And I will show you with the help of a data how it works. For example, there will always be a reason to sell equities, or there will be always a reason to not buy equities, because something or the other keeps happening in the market. There will be multiple crises, there will be recessions, there will be changes in government, there will be elections, there will be something, if not in India, then there could be certain problems coming from outside. But overall, there will be some or the other reason always where you will feel that we should not enter into equity today. But if you forget all this noise and if you don't try to time the market, then you will see that equity has grown 150 times in the last 38 plus years. 150 times, irrespective of all these crashes, declines, scams, whatever has happened. There has been big falls as well, but irrespective of that, equity has grown by almost 150 times since 1986. Even if someone is worried that there could be a very big fall in equity immediately because of various reasons, it could be that you some of you are worried about the war which is happening between Iran and Israel. A similar war took place in 2022 between Russia and Ukraine, which has still not ended. And even that time, for the first week, equity markets reacted in a similar manner. However, it rebounded. Markets are above 35 to 40% since that those levels. Even now, after this entire scenario, in a longer period of time, it is apparent that India will grow because these problems are not available in India. And you can see in front of you that even in the biggest of the declines, for example, in 2000 there was dot-com bubble where the markets corrected by almost 50%, the first figure. Still, if you invested just before the fall, so you invested at a very high market, and after that, there was a fall of 50% for the next 2 years. In spite of that, if you have not sold your investment and if you are still continuing your investment, then you can see your returns are 13% compounded. Is it better than your options? So, if suppose at that time you invested in debt and stayed invested, your returns would be close to 8%. Meanwhile, inflation in this entire period is close to 6% average. So, like I said, to beat the inflation, you need returns like equity. Otherwise, on a post tax basis, it will become difficult to beat the inflation. And if you are unable to beat the inflation, then you don't create any wealth. Similarly, 2004, 2006, there were 30% kind of a fall. But if you invested just before the fall and are continuing your investment, then your returns are close to 12, 15% and 12% each. Again, your option was if your option was debt fund, then the returns are in single digit 7 to 8% and inflation has been 6%. The biggest crisis that India has seen is the global financial crisis, where the equity is corrected by almost 60%. Even during 2008, before the market started correcting, 4th Jan 2008, if you invested your money and you stayed invested till date, then you have still made 10% kind of a CAGR, compounded returns, whereas your debt has been around 7%. So even in the worst of the worst case scenarios, if you have invested, your returns are still looking in double digit in equity, whereas in case of debt, it is in single digit, whereas in your inflation is very close to what you are generating in debt. The latest example is the COVID crash. So if you invested before the COVID crash, then still your Nifty 50 returns are close to 18%, which I would say is impressive. Your debt returns are only 6%. So even if you are very pessimistic on the market that markets might correct, there is only one solution. You have to just increase the time period. You have to stay, you have to stay patient for a longer period of time, because even in the biggest of the bull markets there has been corrections. So you will never be able to time the market that okay, this is the time where I should exit or enter, or this is the time where I should stay invested for a long period of time, or I should keep doing the entry and exit. So this is a very easy example where you can see that after a almost 2 year fall between 2000 to 2002, when the markets rebounded, when the biggest bull market began, even in that biggest bull market, there were six declines. And these declines were significant. They were not less. These were more than 10%. So, like I was saying, rather than timing them, all you had to do was just stay invested through them. And in a period of approximately 5 years, your money would have grown close to 8 times. So, overall, if we cut the noise, stay invested, stay patient, then we will be able to make money. And there is another example for that. Let's take a scenario where in 2005 you invested 10 lakh rupees. Okay. So in 2005 you invested 10 lakh rupees. What is the value of that money today? It is close to 1.5 crore rupees. The first bar is 1.52 crores. And in this 1.52 crore, you did not time the market at all. You did not do any entry or exit. You stayed invested for the entire period. Your returns on a compounded basis, annual returns are 14.8%. So very close to 15%. But the important thing is you did not do any timing. You just invested on that day 10 lakh rupees and you are still invested without doing anything. And we are just talking about again Nifty 50. We are not talking about any mid cap, small cap, any other actively managed fund. If suppose you did not stay invested for the entire period, you thought, let me try some timing the market. And in doing that timing, you missed five best days. In those 19 years, you missed five best days. Now, these best days means these were the days where the equity run up the most. So you can see your value from almost 1.52 goes down to 98 lakhs. So there is almost a loss of 50 lakh rupees just because you were trying to time the market. If you missed 10 best days instead of 5 in this entire 19-year period, then the value goes further down to 72 lakhs. 15 best days, the value goes down to 55 lakhs. If you miss 40 best days in a period of 19 years, then the value goes down to 18 lakhs. That is hardly 3% compounded returns. So even if you had 10 lakh rupees in 2005 and you were trying your best to manage those 10 lakh rupees and get the most out of it, in doing that, if you miss the best days, you just look at the loss that you're making. Now, if someone feels that they are very confident, they will not be missing any of the best days, they'll try to capture all the best days. Let me also tell you that these best days were in between the worst periods of the Indian market. What is the worst that you can think? It's 2008, naturally. We just saw here 2008, almost 60% correction. Then there is 2020, 38% correction after 2005. Then there is this 2006, 30% correction. These were some of the worst periods after 2005. Now the best days also came during the worst periods. Like you can see here, 2006 best days, 2008 and 9 best days. There are almost 22 best days here. Then 2020 COVID period, 4 best days. So overall, if you miss the best days because the market sentiments are not good, or because overall there is a lot of negativity around, then you will lose out on a lot of returns. And it is very, very difficult to time the market. Even the best of the fund managers, they find it difficult to time the market. And that is the reason why they do not go and exit the market completely. They do not go and exit the equity completely. They try to do something else. Let us understand why. What? So, if suppose we look at the markets and for future reference, we see that our expectation from the market is close to 12%. Then our expectation in terms of returns will look something like this. Suppose you invested 1,000 rupees, then over a period of next 5 years, there will be 12% compounded returns for the next 5 years. So every year you will expect that the returns are 12%, 12%, 12% each. Correct? But does that happen in real life? In reality, the returns could vary. First year could be a moderate kind of a scenario, followed by negative returns, then extremely high returns, again negative returns. So overall, you will still make 12% returns. But look at the journey. The journey is not linear. There are a lot of ups and downs. Our expectation is that every year we will get 12%, but there are a lot of ups and downs. What will happen because of this ups and downs? First year was moderate, so probably you will give it another year. Second year, when the returns are negative, then maybe you will feel that equity is not the right asset class and you might exit, and you will try to find comfort which you will find in a fixed income instrument. A fixed income instrument, although the returns are fixed, but they are not very high. So, say you will have to make do with a 7% kind of return. You will get 7% every year, but the overall return, what you invested in the initial period, that is 1,000, if you see after 5 years, it has only become 1,138. So, your CAGR return goes down to only 3%. Now, why is this happening? This is not happening because the market did not generate return. Market did generate return 12% in a 5 year period, but you were not patient enough to stay invested for the entire 5 year period. And that is the reason why there is a difference between what returns you get and what returns market generate. This difference is called as behavior gap or investor behavior gap. So what are the different options that we have to invest? If I don't want to just invest into equity, I have option to invest into debt. I have option also to invest into gold and other commodities. If I use these other options, probably my portfolio will look a little better. So for example, in case of equity, in 2011 there was almost 25% fall, but in case of debt, it generated 18% positive returns in the same year. So if you were invested in both equity and debt in equal amount, then your returns would not be very, very extreme. It won't be negative 24%, and you can protect some returns at minus 3%. Similarly, you can see in 2017, your equity gave superb returns at 27%. Debt was not that great at 5%, but still, because you had a mix of equity and debt, you managed to generate close to 16% return, which is not bad. So, using multiple asset classes, different asset classes in different allocation can many a times help you from the extreme volatility. And that is where you need to understand the risk and the return part. Most of the times, as an investor, what we look at is return. Even if today, if you go to any website, they will be only showcasing the returns. So, what we will do is look at 1 year return, maybe 3 year return, 5 year return, and based on that, we will make our investment call. But does that really work? Because if we just look at the returns, then the picture might not be complete. For example, look here. If we see the different portfolios here and the return potential, portfolio D has the highest return potential at 25. So people might feel that portfolio D is the best. Some of you who are very, very risk averse might look at just the risk and decide that portfolio A is best because portfolio A is taking the least risk. But if you look at both risk and return, both of them simultaneously together, you will realize that portfolio C is offering the best risk return reward at 1.4. So that means for every unit of risk that portfolio C is taking, you are getting 1.4 times the returns. And that is why we always suggest that don't just look at returns, look at both risk and return. So by doing this, we can divide our strategy, our portfolios into four different quadrants. The first quadrant will be where the returns are high but the risk is low. I am assuming that most of the investors fall in this particular quadrant where you want high returns but you don't want high risk. You want low risk. Second quadrant is the most popular one with high returns, high risk. This is where most of you are investing today, where you are taking high risk and generating high returns, but it can go the other way around also. Then the category or the fixed income category comes here, where the risk is low and even the returns are low. And the last category is the worst, where the risk is high but the returns are low. This typically happens when the equity markets are very, very expensive. So, over the next few years, your returns go down, but your risk that you're taking is extremely high. So, what do we want to do? Let us understand. The green dotted line that you can see over here, this green dotted line, this is the expectation of an investor, which is linear in nature. It goes up at a steady pace. Like I showed you the other example of 12% return expectation. The black line, the black arrow that you can see again, the black line is linear, but there is a gap between what customer is expecting, what investor is expecting, and what the fixed income is able to generate. And that gap, because of the that particular gap, it is not a super investment option. It's more of a low risk, low return kind of an option. And you will see that this gap will continuously increase as the time progresses. Now, when it comes to equity, in case of equity, um, the blue line, you can see there are a lot of ups and downs. It is going above the client's expectation, it is going below the client's expectation at multiple levels. It is maybe in a longer period, it will exceed the client's expectation. But the entire journey has a lot of ups and downs. And as a result, there is a possibility that you might exit here or you might exit at this point where it is much, much lower than what you are expecting from it. So, what is the solution? The solution is asset allocation, where you don't just rely on one asset class. You invest into equity plus debt plus gold, multiple asset classes. You can see the red line. This is the asset allocation where it is very close to the expectation. There are ups and downs, no doubt, but at least it is very, very close to the client expectation. Now, why do we say that asset allocation can be very, very useful and it can help you to meet your expectation with minimum volatility? So, we can use an example over here. If you see, if you invested 100 rupees and this 100 rupees increased by almost 100% to 200. After that, if there is a 50% fall, yeah, again 200 will come back to 100. Again, if there is a 100% rise, your 200 will again go back to 200. So there were two rise of 100%, one fall of 50%, and your value has grown from 100 to 200. If you use asset allocation, then probably your rise won't be as high as 100%, it will be lesser. So say you rose only 80%, so value goes to 180. But even your fall will be protected. So if you fall less, then the value goes to 135 instead of coming back to 100. From 135, when it again rises to 80%, your value will be close to 243. And that is the reason why asset allocation will recover fast and will generate higher returns by taking lesser risk, or you can say by being more and more efficient. So why should we use this? We should use this for two main reasons. One is to manage our own behavior, because we might not have complete understanding of the market, and as a result, we might act on fear and greed. Another reason is to manage the cyclicality of asset classes. So each asset class, like equity, debt, gold, each asset class has a cyclicality. They go up, down, and it keeps on happening. So to manage that also, asset classes, different asset classes can be very, very useful. So we just saw how we can navigate a volatile market. You don't need to do complete ups and downs. What you can do is instead, you can create a rope way, create a middle way, middle shortcut. And by doing that, you can have a much smoother journey compared to the complete ups and downs of equity. Why should you focus more on asset allocation? So very interesting study was done. This study was done in 1991. Okay, so this study in 1991 was done by a few gentlemen who published a study called as determinants of portfolio performance. So they wanted to understand what are the uh, determinants which impacts a portfolio. So they removed the list. They tested it with security, different security selection or fund selection. They tested it with market timing. They tested with asset allocation and other factors, maybe GDP growth, inflation, and all the other factors, just to see what are the major factors that impact the portfolio performance. What did they find in the end? The pie chart that you can see in front of you is the result. So they found that 91.5% of the portfolio performance is happening because of asset allocation. Can you imagine that? We give the least focus on this particular aspect, and this is the most important determinant for your portfolio performance. Where do we focus the most? We focus the most on security selection, we focus the most on market timing, and then the other factors also. We are worried about whether we should enter the market now or later, things like that. But ultimately, what is impacting your portfolio the most? That is asset allocation. So I would again recommend everyone, please focus more on your asset allocation. Asset allocation means how much money you are putting in which asset class, at what time, in which quantity, because ultimately that is determining the portfolio performance the maximum. I will give you an example. Suppose during the COVID period, if after the fall, if you were in fixed income, no matter which fund, you were not able to generate very high returns. But if suppose if you were in equity, again doesn't matter which fund, you were able to generate superb returns. So rather than focusing on which theme, which sector, which fund, you just have to focus on investing in the right asset class at the right time in the right allocation. Sizing is also important. Post COVID, if my only 5 to 10% was in equity, rest was in debt, again my portfolio would not have made good returns. So I have to focus on the right allocation also at the right time in the right asset class. The cyclicality of the asset class can be seen in a beautiful way with this particular chart, where you can see every year uh, the winners are changing. In 2010, gold was the highest generating asset class, followed by real estate, then your Indian equities, followed by US equity, and then debt. 2011 again, gold did the best. 2012, gold dropped. 2013, gold dropped further. It was negative 18%. Then for the next 3 years, gold was consistently the worst performing asset class. Then it rallied in 2016. Again, it dropped in 2017. Again, it was the best asset class in 2018, did well for the next 2 years, dropped again in 2021 to the last place, negative 2.7%. Again, rallied in 2022, then dropped in 2023, then in 2024, again, it is rallying. So, I think with the highlights that I've done, you can see a complete cycle of gold. The same thing you will be able to see in other asset class also. Only thing is there are certain asset class which has a longer cycle. There are certain asset class which has a smaller cycle. For example, real estate has a longer cycle. As you can see, from 2011 to 2013, your real estate did the worst. 2015, there was slight improvement, but again 2016, 17, 18 till 2020, your real estate was not the best asset class to invest. So the cycle was almost for 9 long period. After that, there was slight improvement, but still it has not improved completely. So these things will keep happening. The cycles will keep happening. We what we need to do is we need to do asset allocation and stay patiently invested. If suppose any of you is confused that how we will understand when to invest into equity, when to invest into debt, of course you can take help of experts. You can take help of your relationship managers or advisors that you have. There is a shortcut that I can tell you. This is provided by ICICI Prudential on a monthly basis. In their fact sheet, it is published, and this index highlights where is the equity valuation today. So if the equity valuation is high or low, it is very easy to understand from this index. When you look at the index, there are different colors. All you need to remember is traffic signal. Everyone has seen traffic signal. There are three important colors: green, red, and yellow. So over here also, if your index is into green zone, then you need to invest into equity. Start investing. Like in traffic signal, we start. Here also, you need to start. If it is in the red zone, then you need to stop investing. Like in traffic signal, we stop here also. If it is in the yellow zone, then in yellow zone, you need to be cautious, but you need to continue investing. So in traffic signal, how we are cautious, we look at the both the sides and then we cross. Similarly, here also you need to be very, very cautious about your investment. There are opportunities, but you need to be choosy about it, selective about it. So right now, it is a very good time to be selective, to be choosy while you are investing, and that is the reason why asset allocation is one of the best ways, or hybrid funds are one of the best ways to navigate the current equity market. So that was about people who are looking to invest in a lump sum manner. What if you want to invest in a small amounts? You don't have lump sum accumulated already. That is where we will understand a little about SIPs or the power of compounding. Can SIP be done at any age? Answer is yes. Can it be done by anyone? Answer is yes. Do I need to look at the market scenario before doing SIP? Answer is no. You don't need to look at the market before doing SIP, because the superpower of SIP is the averaging that it does. So no matter when you invest, SIP will average it, and that is the reason why SIP can remain very, very relevant for a longer period of time without worrying too much about it. Here in the chart in front of you, you can see there is a shortcut to understand SIPs, because we have a lot of confusion that how much SIP should we do. Ideally, whatever you are earning, your SIP amount should be dependent on that. You can do a 20% SIP, you can do a 30% SIP or more, depending upon how much expenses also you have. But if suppose you want to see how much SIP will take you to 10 crore rupees at a nominal return rate of 12%, then here is this particular chart which can give you an idea. Now, why are we assuming 12%? I already showed you few graphs where you could clearly see that equity in the last 20 years, in the last 30, 40 years, has generated return close to 14, 15, 16%. So we are taking a conservative 12% returns and trying to understand what would be the SIP amount required to reach a 10 crore amount at the age of 60. So consider this as your retirement amount. So when you are at the age of 20, the per month amount to reach 10 crore at the age of 60 with 12% return is only 8,400. As you reach 25, this amount has doubled to close to 15,400. As you reach 30, the amount has again doubled almost to 28,329. At the age of 35, again it is close to double at 52,000. So every 5 years, the amount that you require to reach 10 crores is almost doubling. And that is the reason why we say time is money. Earlier you start, the better it is, more compounding you will get. Now, how does compounding work? Let us understand that also. If suppose you did this at the age of 20, SIP that you require was 28,329. So you did a round figure of say 30,000. Your age is 30. You did a 30,000 rupees SIP per month, and you continue doing this SIP till the age of 60. So how will you make money? How does it look like? So your first 50 lakh rupees you will reach in approximately 8 years. In this scenario, you can see your own investment comprises of 59% of the corpus, and the rest 41% is from the returns. Returns, again, what we are assuming is only 12%. The next 50 lakhs you will reach in 4 years and 1 month. Over here, the your own contribution reduces to only 29%, and the returns contributes to almost 71%. Another 2 years, 9 months, and you cross another 50 lakhs. So you have accumulated almost 1.5 crore rupees in the 15-year period. Your investment contribution is further reducing, and the contribution from your returns is increasing. And this is what we call as compounding. The time taken to reach the next 50 lakhs is continuously reducing. Your contribution is continuously reducing, and the returns part is increasing. As you can see, the time keeps on reducing for the next 50 lakhs, and after 3.5 crore, you are not even taking one full year to reach a 50 lakh amount. You are able to reach that amount within a year, in 11 months, in 10 months, and this will further reduce as you move ahead. Even your contribution has reduced to only 6% after 23 years. So after 24 years, you are reaching 5 crore rupees if you do a 30,000 rupees SIP, and you are assuming a 12% returns. What if you keep increasing the SIP by 10% every year? Then what will happen? Now, please understand why am I saying this? Why am I saying that you will keep increasing your SIP amount? First, your income or your salary or your business income, it will not remain the same every year. It will keep on increasing every year. So if your income is increasing, don't you feel your investment should also increase? So if you start at 30,000 rupees, next year if you are increasing it by 10%, so 30 will become 33,000. Next year it will become 36,300, and so on. It will keep on increasing 10% by every year. Then what happens? Then when will you reach 5 crore amount? Will it take 24 years or will it reach early? Let us see. So if you are doing this, then your first 50 lakhs you are reaching in just 7 years. In the previous example, we saw that it took you 8 years. Here it is only taking 7 years. So you are reaching it faster. The next 50 lakhs only in 3 years, the next 50 lakhs only in 2 years. And overall, if you see, 19th year, you are already reaching 5 crore rupees. So 5 years you are saving to reach the same amount of 5 crore rupees. Why? Because you were investing, you were increasing by 10% on a year on year basis. This facility is SIP top up or step up SIP facility, which will help you to increase your SIP on a annual basis and reach your target much faster. So why do I say time is money? This is the best example of that. As you can see, there are three different examples of people. One who started at the age of 25 with 10,000 rupees per month. The other one started at the age of 35 with 14,000 rupees per month. And the last person started at the age of 45 with 23,334 rupees per month. Now, all the three people, different SIP amounts, different start period, but they all are ending at the same time period, that is at the age of 60. So, what is their total contribution? They are all the three, their total contribution is 42 lakh rupees in all the three scenarios. For the first person, 10,000 rupees per month for 35 years is equal to 42 lakh. For the second person, 14,000 rupees per month for the 25-year period, 42 lakh rupees is the total amount. And for the third person, 23,334 rupees per month for 15 years period, total amount invested from their own pocket is 42 lakh rupees. Now let us see how much that amount has grown. For the first person, the amount has grown to 6.5 crore rupees when that person retires at the age of 60. For the second person, it is less than half of the first person at 2.7 crore, and for the third person, it is less than half of the second person at 1.2 crores. All the three investors invested the same amount, that is 42 lakh rupees. All the three investors are getting the same returns, that is 12%, but the final amount that they are getting is different. What is different is time. First investor has given the maximum time for their money to grow, and that is the reason why the corpus value is much higher than the other two even combined. The second gave little lesser time, so their corpus value is little lesser. The third one gave much less time, only 15 years, so the corpus value is also less. This is one of the most important lesson that you need to understand as an investor, that rather than looking at tens and thousands of things in a volatile market, what is happening with Iran, what is happening with Israel, what is happening with economy, inflation, US interest rate cut, what the central banks are saying, instead of focusing on that, if you just focus on patience and discipline, you will be able to generate more than decent returns. And that is the entire presentation was all about. Two important solutions takeaways for all of you. One, practice asset allocation. Don't put entire money in debt, don't put entire money in equity, don't put entire money in gold or real estate. Divide it. Second important thing is SIPs should be long term in nature. You should remain patient and disciplined. Continue doing SIP for as long as possible, as long as your objective does not get over, and you will be able to reap the rewards in the best way possible. So, thanks a lot. I will end my presentation over here. If there are any questions, we can take certain questions.
Am I on stage now? Thank you, sir. That was indeed a wonderful presentation. And I think we have all learned a lot about how to navigate volatile markets, how asset allocation is going to help us in our life in long terms. Before we conclude, as you said, we would like to take up any questions there would be. There are a few. I would pin those questions to the screen and then you can read it, or I can, yeah, there is one on the screen. Can you see it?
Yeah. So, question is from Mr. Ravindran, who is asking, when the present scenario is expected to be normal, is it going to continue for a longer period? So, I think very valid. Most of us would want to know this. If the market is heading towards a direction, or is there going to be a change? So, first thing is, we can definitely have some predictions, right? We can do some calculations that what might happen, what could happen, but will it happen, that we don't know. What is in our control, asset allocation or doing SIPs, all these things are in our control. The markets are not in our control. So looking at the markets today, when we look at India, the macroeconomic scenario looks great. We are not facing inflation problems. We are not facing economic growth problems. Demand is good. Credit growth is good. Your PMI numbers, IIP numbers, GST numbers, all these are coming good. So overall, domestically, we don't seem to have any big macro challenge, and that is the reason why we should not expect very high or very sharp kind of correction. And that is one of the reasons why we are not very negative on equity as well. Even if the valuation seem stretched or a little higher, still we are not giving any exit call from equity, or we are not saying that get out of equity. The reason being, the macroeconomic scenario of India continues to remain strong. Even the corporate earnings continues to remain decent. I won't say that they are as high as what they were the last year, but they are still not bad. So overall, we expect that India should not have a sharp correction. It should do well. At the most, the returns could flatten out for a time being, or there could be a moderate return scenario in the next 2 to 3 years.
The next question is pinned to the screen, sir.
Okay. Yeah. So Mr. Srivastavi wants to know, can you please tell with example how to do asset allocation in regular or direct? All right. So see, there is a one very big difference. SEBI came up with the direct option so that people who are aware of investments, people who are aware about mutual funds, they can get an option to go ahead and directly do whatever wherever they want to invest. But for majority of Indians who are unaware about mutual funds, stocks, how does these things work, when to enter, exit, all the things that we just discussed, there is a regular option where they can consult someone, where they can go through a distributor or an advisor, someone like that. And that is where your expertise come into play. If you are someone who understands these things, only then go and do asset allocation in direct by choosing variety of funds like some equity funds, some debt funds, some gold funds, keeping them in the right allocation. If you feel that it is too much for you, it will take a lot of your time, and maybe you won't be able to do it, you justify it, then probably you should look for an expert. Because many a times in this debate of regular and direct, we end up losing a lot more money than what we would have given in a regular plan, because we try to do it ourselves. Another easy way for someone who is going direct is look for dynamic asset allocation category fund. Dynamic asset allocation is one such category in the hybrid space where asset allocation happens, and it happens automatically without your involvement, without any advisor's involvement. So that is one area where again you can go. So first preference would be always consult an advisor, expert who knows about these things. But if still you want to go via direct, then you can look for a dynamic asset allocation category fund.
I think that is it. This was the last question for the webinar. Sir, thank you so much for taking the time out and doing this with us. I think your expertise in the subject were clearly visible throughout your talk here. Thank you. Thank you so much for doing this with us. We appreciate your time and effort. Thank you.
Thanks a lot for hosting me. I would say to everyone that mutual funds are subject to market risk, so please read the offer documents carefully before investing, the standard disclaimer, and invest correctly. Please don't be greedy. Please read and research and only invest your hard earned money. Thanks a lot and have a great day.
Thank you. Thank you, sir. Thank you, viewers. Thank you for your time. Thank you.